Hi, I'm Mullis from Stratactics in Boulder, Colorado. This afternoon we're going to look at the purpose and structure of the balance sheet. I'm going to use a very simple example to teach this to you. We all know that every company, in order to get started, has to have cash. And so pretend for a moment that you're starting a company and you have $5,000 of your own cash and you're going to borrow $10,000 from the bank. Now, here we are in the U.S., and in the U.S., cash, of course, is green. We call these greenbacks, so we're going to use green as our color for cash. I'm going to place that cash here on this board, $5,000, which is what we provided the business, and we're going to put the label here to call it cash. Now, the balance sheet is actually set up in a special way. It has a line drawn down the middle that divides it into the left side and the right side. Think of the left side as representing all the things that we have and use in our business. And the right side, if we have something, somebody had to provide it, so the right side shows us who provided that. And of course, you provided the $5,000 out of your own pocket. Let's assume you've set your business up as a corporation. This is your $5,000 that you provided, and you are the shareholder, so this is called shareholder capital. Now, from the bank, we got an additional $10,000. So I'll put that right here. That's the cash. Of course, the bank is not a shareholder, so we have to create another category. We're going to put $10,000 pink here and call that short-term loans, or you might see it called notes payable. You might notice there's something already that's interesting about the balance sheet. The total here on the left side is $15,000. Notice the right side, $10,000 plus $5,000 is also $15,000. Since we have it, somebody provided it, the left and right side must always be equal or always in balance, which is why it's called the balance sheet. Let's take this a little further and look at the three parts of the balance sheet. Again, the left side is what we have and use. We call these assets, the things or resources that we have and use in the business. Now, on the right side, we have two colors, so two sections. Let's look at the bank's $10,000. We can say that we owe them that. We could also say we're liable to the bank for $10,000. So this section is called liabilities. All of the money that our business owes to people that have provided some asset to us. Below this line here will be black. This represents the part of the business owned by the owners, called owner's equity. The owner's equity section literally is the total number of assets that you have that are free and clear of any debt. Since the assets equal liability plus owner's equity, that's what's called the basic accounting equation. I'm going to put this little sign up here that expresses that equality. Think of this as the basic accounting equation, or the basic structure of the balance sheet. Now, clearly as we move along in our business, we're going to spend money. We'll owe other people money. People owe us money, so it's going to get a little more complicated. Let's just see what assets we might add. As customers owe us money, we'll add accounts receivable. If you sell a physical product, you're going to have some inventory. If you purchase things like insurance or maybe pay rent in advance, if you pay for those in advance, you're going to have an asset called prepaid expenses. If you buy buildings or equipment, you'll have fixed assets. So those are some examples of assets on the balance sheet. Now, for liabilities, if we have suppliers that we get things from and owe them, we'll have accounts payable. If you have employees that you owe money to, you'll have accrued wages and benefits. If your business takes deposits from customers, you'll have a liability called advances from customers. And of course, when we have sales, we want to make a profit, so we'll have earnings year to date in the equity section. So you can see as it gets complicated, each time you look at the balance sheet, you're going to look at it at where it is right now. So we say that the balance sheet, or the nature of it, is it's like a snapshot of our business. So we take that snapshot right now. It means that when you see a balance sheet, it's only good for that moment in time, because it's going to constantly change. Think of the balance sheet as a snapshot of a moment in time that shows us your company's financial position at that particular point in time. Thank you.